If you're looking to buy fuel cell stock, then please keep watching this video because we're going to look at the company's recent news, how the market treats the company, and what are the technicals telling us. Most importantly, we're also going to take a look at what should be the best trading approach. As the market is still very volatile for the moment, we should always keep in mind that we gotta be careful about what we take on in our portfolio, as well as their individual timing and risks. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. FUELCELL has been an interesting stock to cover over time, as the initial interest in the company has been caused by the assumption that FUELCELL operates in the hydrogen sector, which was a very popular concept back in 2020. Of course, market participants eventually moved to the fact that the company is well established with an expectation that it can generate a net profit unlike many of its previous years. So far, I have to say that investors have sometimes been rewarded by the market, but generally speaking, not by the fundamentals. FUELCELL has been caught by the world events, which may not have benefited its operations necessarily, as natural gas price went up. With that being said, I think that the current price action has bottomed the stock price around May 11th, and the stock has been able to edge upward ever since. Let's also take a look at its technicals. The trading volume of FUELCELL has recently been around 6.7 million shares versus an average volume of 12 million shares. Over the previous 52-week period, its price fluctuated between $2.87 and $11.63. The volume of shares traded tells us how many shares are being bought and sold at any given time in the market, and if there's enough liquidity to support a trading strategy. If the float is very thin, it would be easy to influence the stock price, but the low liquidity could also mean that the demand is limited. When we compare the current volume against the average one, there might be a possibility for trend reversal or breakthrough if the difference is very large. The market cap of FUELCELL is currently around $1.3 billion versus an enterprise value of $1.2 billion. Simply put, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is the cost the company paid for its assets after paying off the debts. It's worth mentioning that one of the most significant assets for many growth companies are the intangibles. They are the pledges for a better future, such as intellectual properties, brandings, and schematics. For startups, most of their valuations are based on the intangibles, meaning they could be valued in more favorable market conditions, and in concrete terms, they can also give investors the impression the company is trading at a discount. It's trading below its book value, and that doesn't mean that a company is undervalued per se. It's possible that the company itself was overvalued in the first place and only deflated itself ever since. As we compare the current price to the historical price fluctuations, it's 4% higher than the 1-month low, 24% higher than the 12-week low, and 24% higher than the 52-week low. On the options market, giving us a hint about the market sentiment, the implied volatility is currently 88% versus a historical volatility of 73%. The put-call volume ratio is currently around 0.23. It is normal for most stocks to also have a higher put option volume than what they truly deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 8,000 contracts in a day compared to the 30-day average of 14,000. In terms of open interest, the most recent volume of open interest has been 180,000 contracts versus the 30-day average of 213,000 contracts. The option contracts are tools allowing traders to hedge their risks, increasing their exposure with limited downside, or to have a revenue stream. They are derivative contracts based on the underlying security, and they give the traders the possibility to buy or sell the security at a predetermined strike price. The put options allow selling at the strike price, usually for anticipated downturns, and the call options allow buying at the strike price, usually chosen for anticipated bullish runs. Regarding shareholder structure, Institutional shareholders own 32% of its outstanding shares, and the biggest shareholders include Vanguard, iShares, and BlackRock. It's always good to see some institutional participation if we decide to hold the stock long term, because it offers a layer of stability and a token of reliability. It means that the market is confident that it'll deliver value in the long term, which is important to consider for investors. I personally consider the minimum threshold to be around should be about 25 to 30% for institutional ownership. Now, let's also take a look at the short interest of the stock, which is the number of positions aiming to profit with falling stock price. The way it works is that short positions will borrow the shares from brokers, sell them in the market now, and to buy them back later, profiting from the difference between the two timings. If there are significant short interest, usually above 25 to 30%, there could be a potential for a short squeeze, whereby traders can still buy the stock up, forcing those with short positions to redeem their positions to avoid their losses, which acts as a buy for the stock's price action. This is what people refer to as a short squeeze, which became a popular concept in recent times with successful short squeezes such as GameStop and AMC. The current short interest is 13% of the total float, with 57% of the transactions out of the dark pools. Usually, if it's above 15% of the total volume that has been short, then there is potential for a short squeeze. Given the current conditions, my recommendation would be to increase your exposure in FUELCELL and hold it for at least 3 to 6 months. I would recommend to commit around 1% of your portfolio's capital in FUELCELL, and I would recommend to further split the allocation in about 20 to 30% at a time to purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.